Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else.
Friends, welcome to another video on your channel Profit in Equities. If you like our content, please don't forget to hit the like button. Also subscribe to our channel, click on the bell button and choose all notifications to receive important financial updates from our channel at the earliest. In this video, we will be talking about 5 stocks which are strong buys after the June quarter results. Please watch this video to know more. Now the first stock on the list is NATCOPHARM Limited, which is available at Rs 754.40 and the face value for it is 2. The symbol for it is NATCOPHARM. Now NATCOPHARM Limited is a pharmaceutical company. The company is engaged in developing, manufacturing and marketing finished dosage formulations and active pharmaceutical ingredients. The company's segments include active pharmaceutical ingredients, finished dosage formulations, job works, pharmacy and others. Now, as is visible from the 1-year chart, the stock was on an uptrend for about the half of the year but then had a severe fall and has been consolidating ever since. The market cap of the company is 13,918.18 crores, which means that the company is a mid-cap one. The EPS of 42.79 translates into a price to earnings ratio of 17.63, which is much cheaper when compared with the industry PE of 30.21. The book value of 169.40 however translates into a price to book ratio of 4.45, which is slightly on the higher side. The company has a dividend yield of 1.09%, whereas the promoter holding stands at a figure of 48.38. The 52-week high for the stock stands at 1050, whereas the 52-week low is 695. Now the company reported steady Q1 FY19 numbers. The net profit grew by 93% and revenue rose by 21% on a year-on-year basis. The company enjoys a leadership position in the domestic oncology and gastrohepatology segments. Its oncology segment has a portfolio of 30 products covering about 1/4 of the domestic market. Going forward, growth in revenue and profit will be driven by formulations business in the US that includes niche generic product launches. This company is expected to do very well going forward. Now the second stock on the list is OBEROIRLTY Limited, which is available at Rs 474.85 and the face value for it is 10. The symbol for it is OBEROIRLTY. Now OBEROIRLTY Limited is engaged in construction and real estate development and hospitality. The company is involved in the development of approximately 40 projects that aggregate over 9.18 million square feet of space. It handles residential, commercial, retail, social infrastructure and hospitality projects. Now, as is evident from the 1-year chart, the company was on a slow uptrend for the initial half of the year but since then has been consolidating. The market cap of the company is 17,265.65 crores, which means that the company is a mid-cap one. The EPS of 16.23 translates into a price to earnings ratio of 29.26, which is just about in line with the industry PE of 27.92. The book value of 123.37 translates into a price to book ratio of 3.85, which is a bit on the higher side. The company has a dividend yield of 0.42%, whereas the promoter holding is a strong factor for this stock and stands at a figure of 67.70. The 52-week high is 610, whereas the 52-week low for this stock stands at 361.55. Now the stock has been on a time correction despite excellent Q1 numbers. Profit after tax and revenue were up by more than 200% on a year-on-year basis. It is the right time for long-term investors to accumulate this stock as valuations are very reasonable. The real estate company is focused on premium developments in the residential, office space, retail, hospitality and social infrastructure verticals. Now the third company on the list is ASHOKLEY Limited, which is available at Rs 128.35 and the face value for it is 1. The symbol for it is ASHOKLEY. Now ASHOKLEY Limited is a holding company. The company is engaged in commercial vehicles and related components. Through its subsidiaries, it is engaged in manufacturing and trading in medium and heavy commercial vehicles, light commercial vehicles, passenger vehicles, automotive aggregates, vehicle financing and engineering design services. Now, as is evident from the 1-year chart, the company was on an uptrend for the major part of the year, but since then had a severe fall. However, of late it has again resumed its uptrend. The market cap of the company is 37,677.49 crores, which means that this company is a large cap one. The EPS of 6.20 translates into a price to earnings ratio of 20.70, which is much more cheaper when compared with the industry PE of 34.93. The book value stands at 24.41, which translates into an expensive price to book ratio of 5.26. The debt to equity is also a little high at 1.6935, whereas the dividend yield stands at 1.89%. The promoter holding is just about average at 45.50. The 52-week high for the company is 167.50, whereas the 52-week low is 100. Now, the company reported excellent Q1 FY19 numbers. The net profit grew more than 200% on a year-on-year basis with stable margin despite rise in the cost of key inputs. Uptick in the economic growth and pickup in infrastructure activity augurs well for the company. The ongoing stricter enforcement of overloading norms is a positive development, but competitive pressure is still likely to remain high. This company may also be on a strong business trajectory going forward. Now, the fourth company on the list is Escorts Limited, which is available at Rs 869.30 and the face value for it is 10. The symbol for it is ESCORTS. Now, Escorts Limited is an engineering company which offers agricultural tractors and construction equipment. The company's segments are agri-machinery, auto ancillary products, railway equipment, construction equipment and others. It is engaged in the business of manufacturing of engines. Now, as is evident from the 1-year chart, the company was on a beautiful uptrend till about 3/4 into the year, but since then has been on a consolidation mode. The market cap of the company is 10,655.61 crores, which means that the company is a mid-cap one. The EPS of 32.86 translates into a price to earnings ratio of 26.45, which is largely in line with the industry PE of 27.29. The book value of 207.88 translates into a price to book ratio of 4.18. The dividend yield stands at a figure of 0.23, whereas the promoter holding is also a bit below average at 40.07. The 52-week high for the stock stands at 1017.70, whereas the 52-week low is 591.05. Now, the June quarter results were operationally better than expected. FY19 tractor demand and margin expansion as offtake has been strong even in lean months. The dealers expect the momentum to continue for the next few months going forward. Now, the final stock on the list is JSWSTEEL Limited, which is available at Rs 334.00 and the face value for it is 1. The symbol for it is JSWSTEEL. Now, JSWSTEEL Limited is a holding company. The company is engaged in the business of production and distribution of iron and steel products. Its segments include steel, power, which is basically used for captive consumption, and others, which include cement, mining and construction activities. Now, the 1-year chart reveals that this company has been on a beautiful uptrend throughout the entire year. Even in the midst of the recent mid-cap and small-cap meltdown, the stock has not really corrected much, which shows the relative strength of this stock in the current market scenario. The market cap of the company is 80,735.16 crores, which means that the company is a large cap one. The EPS of 27.07 translates into a price to earnings ratio of 12.34, which is much cheaper when compared with the industry PE of 16.70. The book value of 115.20 also translates into a reasonable price to book ratio of 2.90. The company has a dividend yield of 0.96, whereas the promoter holding is a bit below average at 41.75. The 52-week high for the stock is 351, whereas the 52-week low stands at a figure of 228.25. Now, the stock is trading at reasonable valuations. The company reported almost 3 times increase in Q1 profits on a year-on-year basis. The management expects steel demand growth at 7 to 7.5% in FY19. There is an expectation for margins to improve further in FY19 even if steel prices remain in a range around current levels. Now friends, please don't consider this to be a recommendation on our part. Please go ahead and do your own research. This and all the other content that you see on our channel is intended to be a piece of news. Also, this is not our own research. We'll be providing the link to the source for this video in the description section. Please go through the same to build more conviction around your investment decision. Also friends, if you like the content that we produce on our channel, please don't forget to share these videos. It motivates us to keep making more such content for you. Thanks for watching, and if you have not yet subscribed to this channel, please consider doing so.